Welcome back, everybody. Now, over the past year, I've added a handful of stocks that are trading at very high valuations. Stocks like Cloudflare, Snowflake, and of course, Palantir. And I've mentioned many times since then in videos that valuation is just something that I don't really focus on anymore because I don't feel like it's a reliable predictor of future returns. So in this video, we're going to talk about why I think that, the things that I looked at and thought about, and how my perspectives changed. So let's go ahead and get started. And what made me think about this is every time I post about stocks that I buy, especially stocks like Palantir, I always get comments like these. Well, friends, this is how FOMO is justified. What do you expect Palantir to be generating in revenue, net income, or free cash flow by 2030 that can justify a market-beating return for the next 5 years? And I think it's probably not going to hurt you at a 5% allocation, but I still want to ask, what is the driving factor of buying here? And now the easy answer to questions like those is, well, the driving factor of buying here is that I think it's going to be worth a lot more going forward, right? But let's get to the root of what these questions are really asking, because they're not asking why I'm buying here. What they're asking is, how could you possibly buy at this valuation? Because these questions are rooted in a single belief, and that belief is that valuation is important and maybe even the most important thing. And my opinion on this, which has evolved over time, is that valuation, and in some ways even value investing, just isn't as predictive as it was maybe in the past. And that's based on the research and thinking and digging about this that I've done. I mean, it's not that I'm just doing it on a whim and, I just want to chase stocks and FOMO and all that. This is something that I actually think has a little bit of data behind it based on how the world is changing. And for me, it started with asking myself just a basic question. If a lot of the best performing stocks in the market are trading at a high valuation, then why is that? Because I think a lot of people will just dismiss it as, it's a, quote, irrational market, it's people being greedy, it's people being speculative. And this started for me back in 2024 when I added Amazon initially to my portfolio. Because I literally was like, look, I'm using my process here. I was using my little spreadsheets back then with my own little, DCF model that I was calculating. And I'm like, if my process excludes a company like Amazon, which is clearly one of the highest quality companies out there, they have a lot of great prospects both for growth and for profitability, then maybe it's not the valuation that's the problem. Maybe my process needs to change. Because at the end of the day, if my goal is to beat the market and a lot of the stocks that are beating the market have high valuations, then again, maybe I'm the one that needs to rethink what I'm doing and not the other way around. And look, I know the first thing that people who are value investors will say, it's the classic Ben Graham quote, right? Well, in the short term, the market is a voting machine. In the long term, it's a weighing machine. But what if there was a little bit more to it than that? Because look, I respect Graham and Buffett and their track records speak for themselves. But some of these ideas that we're talking about are like 75 years old, right? And yes, there are absolutely elements of, the intelligent investor and security analysis that are absolutely timeless. I'm not saying we should go buy a bunch of crappy companies. The things that I tried to think about was, how has the world and the market actually changed over those 75 years? And honestly, if you just take the last 25 years, there have been some drastic changes that, in my opinion, have really changed the predictiveness of valuations and value investing. And so first off, the rise of the 401k basically means that you have more people investing overall, and they're investing in an automated way. And more importantly, this investing is completely price insensitive, meaning that they're just investing every week, every time they get a paycheck. They're not looking at price or valuation or anything. They're just putting money into the market, which means that more money goes into the market every week no matter what, and no matter what price or valuation anything's trading at. And here's just a couple stats for you. Since the year 2000, 401k assets have grown from $1.7 trillion to $9.3 trillion, which is a growth of about 5.5 times. Now, part of that is simply just market appreciation and also additional people in the workforce, but it's a little deeper than that. The estimates are that 50% or so of that growth was related to two things. One, higher participation, which went from 64% participation to 94% with things like auto enrollment. And then second, the ongoing shift from pensions to 401ks from a business perspective. Plus, when you add on the fact that index investing is now more popular than ever, what you've seen is a huge amount of growth in price-insensitive investing that happens basically every 2 weeks, no matter what. So when you think about that a minute, what does that do to the stocks at the top of the index that are going to have money continue to flow into them no matter what, regardless of what valuation they're trading at? What does that do to, quote, normal valuations over time? It would make them rise. So when people say, look at the S&P 500 price to earnings over time, I mean, if you have more and more more money that's just going into the market every 2 weeks with absolutely no thought to price, then yeah, over time, the price to earnings for the whole market is going to continue to go up. So I'm just not sure how valuable that information is, especially when you're looking at it over a long period of time. And then the second reason that I have is that the internet has democratized information. Now, if you think back to when Warren Buffett was, starting to invest in the 1950s, it's not like he was pulling up Yahoo Finance to see the PE of a company. He had to use things like Moody's manuals and S&P stock guides, which meant that you had to have a subscription to them, or even you had to go to the library to use them. So getting to that information was that much harder, and obviously it wasn't at all automated. Or you even had people who would actually go to the company headquarters or factories or anything just to try to get a little bit of info. And if you read books like Philip Fisher's Common Stocks and Uncommon Profits, which is one that Warren Buffett has touted, many times over the years, they talk about this as the idea of like scuttlebutt, right? Where you're trying to get as much information that you can about a company from company insiders or employees. And of course, there are modern twists to ideas like these, and gathering information on a company isn't really going to be a bad thing ever. But think about the difference in edge that you had back then compared to today. I mean, just having access to the information back then was an edge because there were barriers to it, right? So the likelihood that there would be stocks that people just didn't realize were opportunities or that were trading at really good valuations or fundamentals was a lot higher than it is today. Because nowadays, all that basic information is available instantly for free and at your fingertips. So that information asymmetry simply isn't the same as it was in the past. Plus, so much of that data now is being pushed into automation systems to where it's getting consumed and acted upon way quicker than before. Which actually brings me to my third item, the increase in algorithmic trading in the market. Now, people estimate back in the year 2000, about 30% of stock trading volume was computerized algorithmic trading, with today the estimate being around 70 to 80% for stocks and options trades. And the projections are that it'll be closer to 95% by 2035. So what does that actually mean for us as investors? Well, it means that there's going to be more volatility, but it also means faster price discovery. So that edge that you would have had by digging into that financial statement and finding that nugget of information is severely reduced now because of how quick the market moves. So what does this actually mean? Does this mean I think value investing doesn't work anymore or that I think it's bad? Well, no, of course not, right? There are elements of value investing that I think are always going to be beneficial, like making sure you understand what you're actually invested in, understanding an actual business and their future outlook. But I just don't personally believe that valuation is a good predictor of future returns anymore. And that's why for me, I focus on business growth, cash flow growth, alignment to secular trends, and a little bit of technical factors to find good entry points. And I know the natural reaction for some people will be, oh, this is market top behavior, this is speculation and getting lucky on high beta plays, or clearly, I don't know that value actually outperforms growth over time based on the Fama French three-factor model. But of course, I've looked at that in my research and trying to understand where people come from, because this is what I do anytime I try to understand what my own method should be. But even with the Fama French data, I have a lot of questions. Like number one, let's assume that it's correct and that over a 100-year time frame, value actually outperforms growth. Is your working lifetime 100 years? No, of course not, right? Your working lifetime is probably about 40 to 50 years that you have to build a retirement nest egg. So you don't have 100 years to hope for some reversion back to the mean. And the reality is that if you look at this history where value has outperformed growth, the bulk of that outperformance is where? Before the year 2000. And this chart doesn't even have 2020 to 2025, which we know that growth has severely outperformed value. So it's about asking yourself a very simple question. Are you willing to bet your retirement that this study over 100 years is actually indicative of what's going to happen over the next 50? It's up to you. Or do you think that there might be some merit to the fact that since 2000, we've had a lot of changes in how markets work that we just went over? So then maybe that data over the last 100 years isn't necessarily the best predictor of what's going to happen over the next 20, 30, or 40. But let me go ahead and just wrap this up. Now, I'm not saying that value investing doesn't work or that it can't work. I mean, obviously, there's always going to be opportunities in the market where a company is trading for a low valuation and it's just not a popular stock that anybody wants to buy at the time. And that's totally fine, right? But for me, being that my goal is to beat the market, I don't think that valuation is a reliable predictor of returns anymore. So that's why I don't focus on it and I focus on other things. And like I mentioned, those things are business growth, overall outlook and runway of the business, and how aligned it is with secular trends, while also incorporating technical factors that tell me when an attractive entry point might be coming up. And I think a lot of the argument back and forth on this is that I think you have kind of a group of folks who feel like value investing is the only true way to invest, right? Like we talk about things like, well, isn't the stock price just related to free cash flows? And I guess my question to that is, how many examples can you see in the market today where those things don't really line up, or that they're, kind of very out of whack with what's normal? Like, how do you explain that? Is the explanation that, oh, it's just speculation and it's not true investing? Or is it, oh, it's just, a voting machine right now and it's going to end up being a weighing machine? I think those are things we need to think about a little bit more deeper than that, at least from my perspective. Because the reality is that there are people investing and building their nest egg in many different ways out there. And for me, I don't like to get stuck in any previous ideas just because I learned them or read about them before. But to me, I think the ways that the world and the market has changed are actually meaningful, and that's why I've changed my approach, because the rise of 401ks and passive investing has really pushed normal valuations up. The internet has democratized information and reduced the information asymmetry edge, and algorithms and computerized trading are now dominating the daily trading volume. And so for those reasons, I just don't think that valuation is really where I need to be focusing on if my goal is market-beating returns. But like I always say, you should invest in the way that makes sense for you, right? And there's going to be tons of value investors out there who totally disagree with me on this, and that's totally fine. We should do what's comfortable for each one of us. For me, I thought it was important to actually dig into this, and I ended up changing my approach. Now, if you guys have any other questions about this or what I'm doing or why, put them down in the comments, and I'll try to get to them. Now, if you guys want to see what I thought about AMD and NVIDIA's recent deals with OpenAI, you can watch this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins. And I'll see you on the next one. Peace.